Matt, we've been reading and hearing a lot about the Fannie Mae, Freddie Mac, the companies, and also the stocks. There's been a lot of gains, been a lot of losses the last week or so, a lot of volatility here. If someone's even remotely thinking about jumping into this, I think it's really important that they understand the facts behind it. And one of those facts is kind of what's the actual business doing? What is the operating income looking like? And it's not that clear of a picture, right?
Sure. Well, one of the things that we've already covered a lot here is the government's involvement in both of them. They're both under conservatorship, so basically all of the income, essentially all of the income except for a small slice to kind of keep their equity steady, is going to the government. And there's no clear end in sight to that. There may be an end. There's no clear end to sight. But one of the things we haven't really talked about, and I've seen a few different people try to tackle the future earnings of Fannie Mae and Freddie Mac out there. And one of the things I think is a little bit misleading is that when you just look at the first quarter, Fannie Mae's first quarter, as the business starts to recover, as the economy recovers and the housing market recovers, we've had a turnaround in the business from the perspective that Fannie Mae and Freddie Mac have both taken huge provisions against loan losses. And in past quarters, I mean, in the year ago first quarter, for instance, there was a $2 billion provision against loan losses. This is essentially these companies setting aside money, just like a bank would do, setting aside money to say, okay, when these losses occur, we'll have the funds set aside to be able to cover that. But what ends up happening is that if things start to recover a little bit better than their projections, or sometimes they kind of sandbag and they put aside a little bit of extra money, they start to release those reserves. And what can happen is what we saw in the first quarter. So in the first quarter, Fannie Mae actually had a benefit on its provision line. So it was nearly $1 billion benefit on that provision line. So, if we think about it going forward, the $2 billion provision that they took in the first quarter of 2012, that's not really normal, but definitely not $1 billion benefit.
Right.
So we have to think about, well, what does the normal business look like? And so you're going to have some amount of provisions on a normal basis. So as they continue to do basis in a normal environment, they're going to have some charge-offs. They're going to have some defaults that they're going to have to cover. So they're going to take some amount of provisions. It's not going to be $2 billion, but it's certainly not going to be that $1 billion benefit. So you can't just take Q1 2013
And run rate that out.
Exactly, and multiply it by 4, say, well, that's what the annualized looks like, and this is what it's going to go out into the future. You've got to really look at what, the nuts and bolts of the business, what's happening, and adjust that.
Right.
Now, another issue was we've seen all of this hedge fund activity. We've seen a lot of investors jumping into Fannie Mae and Freddie Mac, and particularly preferreds. And you were talking earlier to me today about an interesting point in the Fair Home investment in Fannie Mae.
Right, so Bruce Berkowitz, manager of the Fair Home Fund, he's known for kind of getting into these dirty situations. He's been in AIG, Bank of America, MBIA. So people look at him and say, Bruce Berkowitz probably knows a turnaround situation when he sees one. So it came out, they issued a press release that said they have a $2.4 billion par value of the preferred stake.
You
par
put
value.
A little bit of emphasis
on the par value of the preferred. So we're not talking about the commons that trade over the counter. We're talking about the preferred, 2.4 billion par. So a lot of people came out and said, okay, $2.4 billion. He runs about an $8.5 billion fund. Berkowitz is putting around 30% of his fund into Fannie Mae preferreds.
Not true.
Not true at all.
Okay.
So we're talking about the par value. These are not trading at par value. These are about a quarter or 20%. Or 80% discount, so they're only trading at about 1/5. So he's only putting around $500 million, not $2.5 billion. So really understand that it still is a significant bet for the Fair Home Fund and Bruce Berkowitz, but he's not putting 30%. I mean, he's in the preferred. So don't look at this and say Bruce Berkowitz is doing this is the next turnaround. This is the next AIG, MBIA. He's proved himself. That's not necessarily the case here. It's still a very speculative bet, even for a Berkowitz. So I think investors just really need to be aware of that.
So you've got that par value issue. So the actual investment isn't quite as big as the headline. But then also, as you mentioned, it's also the preferred issue, because if Fannie and Freddie end up getting liquidated, those preferreds will likely get something, may get something. The common in a liquidation scenario probably will get nothing.
Right.
So those are two big issues to understand when you're looking at that Berkowitz.
Right, and it really does highlight kind of the dangers of kind of just following a fund manager blindly, because you could crack open the press release and say, oh, he's putting 30%, maybe I should just follow him. So it's really
30% of my portfolio.
Really important to dig in there and really understand what are they doing.
Okay, great. Moving on.